The Commercial Real Estate Show is brought to you by Cohn-Resnick, forward-thinking advice to navigate business and financial issues. Visit cohnresnick.com. By BB&T, banking, business, and commercial real estate loans. Visit bb&t.com. And Bull Realty, when your business requires proven performance, visit bullrealty.com. And by France Media, providing exposure to the world of commercial real estate. Visit francemediainc.com. Welcome to the Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. Learn market knowledge and best practices to lead your company's success. And that's whatever type of company you work with. And laugh, yes, we have to have some fun along the way. Well, hello, I'm Michael Bull, your host to the world of commercial real estate. Thank you for joining us. Well, today we're going to explore the U.S. multifamily market. You know, apartments have been a very hot sector, with cap rates compressing to pre-recession records and impressive occupancy and rate growth in most all markets. All this in an economy with slow job growth and continued economic uncertainty related to deficit spending. Well, today we'll look at the apartment market, including what to expect as construction of new apartments continues to ramp up and the housing market begins to improve. Let's start with a perspective of the market with Ron Johnsey, president with Axiometrics, an industry-leading apartment research firm. They survey more than 18,000 properties every month in over 300 markets, in over 1,000 submarkets, totaling more than 4.8 million units. Ron, thanks for joining us today.
Glad to be here, Michael.
Well, John, I just want to ask you to start off, how did 2012 end up? Did we have continued improved performance across the country?
Well, 2012 ended well. It was down from, let's say, the U.S. apartment market really peaked in July of 2011 with effective rent growth of 5.3%. 2012 ended up at 3.6%, so you can see that we're down. 2011 effective rent growth is about 4.2%. However, another good thing to keep in mind about it is we saw occupancy increase. And so in the apartment market, when you have a situation where you're increasing rents, even though this pace is a little bit less than, let's say, the peak at 5.3, 3.6% in 2012 is really good. But we saw the occupancy rate go up. We went up by 60 basis points. So if you're in the business and you're able to push your rents and still increase your occupancy, that's a good thing.
Yeah, that's an excellent thing. Well, what do you expect moving forward throughout 2013?
Well, some people accused us in the industry of being a little bit bullish, but we cover so many markets. And so what we're seeing is that some of the markets that were performing really well in 2012, their growth is decelerating. But we have markets that were late recovery markets, and so they're starting to go up. So maybe this is a little aggressive, but we're saying effective rent growth to be the same, about 3.6%. But again, we're seeing the occupancy rate move up, and again by 60 basis points. So this time it's going to go from about 94.3 to almost 95%. And then if we take our models and we look out over a 3 to 5 year horizon, we do not see any trouble for the overall U.S. apartment market. We see rent growth in the 3% range. We see occupancy rates average around 94.5, 94.6. So unless the economy really tanks, we ought to do well. Now, the big problem is going to be the potential for oversupply, and that's very you take markets and then you look at certain submarkets, and the problems can be in certain submarkets for oversupply.
And 3.6 rate growth for 2013, I mean, how bullish is that? I mean, if you look back at historic rate growth throughout the years, how does it compare?
Well, I would say it would probably be one of the better years. If you get anything over 3%, you're really doing well in the apartment business. So historically, it is still really great. What happened to the apartment market was we had the trough in 2009, and rents fell by over 6%. Occupancy went down to about 90%, but there was no supply built for a number of years. And as a result of that, when 2010 hit, it was like a light switch was flicked. And all of a sudden, we were off to the races. Because we survey monthly, we started noticing that we were going from these negative growth rates to positive and, slightly positive, and then and on and on and on. And so, 3% plus is really good. And I think we're going to be in that range for the foreseeable future.
Well, the apartment sector is unique in that it can move pretty quickly with the short-term leases, not as quickly as the hotel industry, but certainly quicker than industrial and retail and the others. Well, what about classes of properties, Ron? How are, say, Class A properties performing and improving as compared to B product?
Well, you hit on a really good point. Because of the nature of the leases are short-term, that means renters can move out and look for a better deal. So what we're seeing today is effective rent growth for Class A properties is declining in some markets quite rapidly. And we call 2012 the year of filling in. It was a year of where Class C properties became better occupied and started having some effective rent growth. On the other hand, we saw the A properties starting to reduce their growth rates. And this is all natural. When you've gone through a number of years where rents have really gone up rapidly, then the impact is going to be to slow that down. And give you sort of an outlier example, you look at San Francisco, they raised their rents like 6% in 2010, but almost 20% in 2011. So that's 26% increase in rents. And by the way, the level of rents in that market are some of the highest in the country. So you're going up 20% in 2 years. Well, in 2012, rents actually decline. So we're seeing that effect going on, throughout the country. And it also gets in another little peeve of mine is that a lot of, let's call it investors, tend to look at the MSA's effective rent growth. Well, that doesn't tell the story. If you had, for example, looked at Atlanta's Class A properties in 2010 increased rent 6.7%. In 2011, it was 6.4%. But if you look at the overall MSA effective rent growth, it was only 3.1% in 2011. Whereas what drugged down that overall market rate was the Class C. And so we've gone to a flip-flop. We've seen in 2011 Atlanta Class A rents increasing 6.4%. They only increased 3.1% in 2012. However, Class C in Atlanta zoomed up 6.4%. So renters are trying to control their housing costs. And so what a renter will do when they get a renewal, and my daughter's a prime example. She's in a really high-rent property in downtown Dallas. They've increased her rents 10% 2 years in a row, over $200 a month. She's now looking to move out. And so I think we're starting to run into that. And that sort of segues into another issue we're faced with in some of these better markets is oversupply. And, for example, in a number of these markets where you've had these big increases in rents, that's where the supply has been concentrated. So the issue then is which markets might, be oversupplied, this year.
And what are the levels of new deliveries compared to previous years?
Well, this is the year when you break it down by units. In 2012, we were delivering about 85,000 units nationally. In 2013, that's going to almost double. It's going up to 168,000. So we're seeing a huge increase. This is sort of a watershed year. This is what I call the first derivative or first wave of new supply that's hitting the market, and we need to see how that's going to work out. Obviously, we're starting to see some slowdown in absorption rates, but it's real spotty. When 2010 started, really, recovering, the developers that were able to get the money to finance new deals went out and did it primarily in the urban cores. So you've got a number of urban cores like Seattle, downtown Queen Anne, Dallas, Oak Lawn, Houston's in the Montrose River Oak area, where you have a lot of supply being delivered into those markets. And so those are the ones we need to watch. As a matter of fact, what we say is close to one-third of the nation's deliveries will just be in Dallas, the District of Columbia, New York, Seattle, Austin, and Houston. So those markets are the markets we really need to look at and worry about oversupply having a big impact on their performance.
Okay, and we're short on the end of the break here, but where do you see opportunities for investors or developers in the current market? I mean, you're bullish on the market, and you're also saying that B and C is filling in. So are B and C where some good opportunities are for growth?
Yeah, absolutely. Even though we haven't covered cap rates here, the B and certainly C category trade at much higher cap rates. So if you can find A submarkets where there are B and C properties and you can buy them at a lower cap rate, and you can get better performance in the short run. I think Atlanta is one of the top markets that ought to be looked at for new development. And we really feel like, for example, Southern California is going to start coming back. It'll be stronger. Orlando, Tampa should be really good markets to invest in this year.
Okay, well, great. Well, we've got an Atlanta apartment broker in the studio today, so he's glad to hear that. Well, Ron, thanks for joining us today. We sure appreciate your insight.
Thank you, Michael. Appreciate it. If
you'd like more information from Ron Johnsey and Axiometrics, their website is axiometrics.com. That's AXIO metrics.com. We're going to take a quick break, and we'll get back. We'll have more perspective on the U.S. multifamily market. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is made available by professionals at Cone Resnick, BB&T, France Media, and Bull Realty. For more information about these companies or to access additional show podcasts or videos, visit commercialrealestateshow.com.